In the early hours of September 16, 1992, officials at the Bank of England were already aware that the day would not proceed as planned. Sterling had been under pressure for weeks, but by that morning, the selling had become continuous rather than episodic. Foreign exchange desks across London were no longer probing the currency. They were exiting it. By the end of the day, the United Kingdom would suspend its participation in the European exchange rate mechanism, a framework it had joined less than 2 years earlier. Interest rates would be raised twice and then reversed within hours. Billions of pounds would be spent in defense of a parity that could not be held. At the time, the event was described as a market attack. Later, it would be remembered as a policy failure. Both interpretations were incomplete. The European Exchange Rate Mechanism, or ERM, had been designed as a stabilizing device. Its purpose was to limit excessive currency fluctuations among participating European economies by anchoring exchange rates within agreed bands. The system was not a currency union, but it was a preparatory step toward one. Stability in this framework was not merely technical, it was political. Exchange rate discipline was intended to impose fiscal restraint, reduce inflation, and align national policies with a shared European trajectory. For much of the 1980s, the United Kingdom remained outside the system. British policymakers had been wary of surrendering monetary flexibility, particularly after a decade marked by inflation volatility and recession. By the late 1980s, however, conditions appeared to have changed. Inflation had come down from earlier peaks. Financial markets had been liberalized. London had reinforced its position as a global financial center. The prevailing belief was that the United Kingdom had matured into an economy capable of sustaining a fixed exchange rate regime without compromising growth. When the pound entered the ERM in October 1990, it did so at a central rate of 2.95 Deutschmarks. The choice of that rate reflected both economic judgment and political calculation. A strong pound signaled confidence and commitment. It aligned the United Kingdom closely with Germany, whose Bundesbank was regarded as the anchor of European monetary credibility. At the time, this alignment was presented not as a constraint but as a stabilizer. The timing, however, was unfavorable. Entry occurred just as the British economy was slowing. Interest rates were high, in part to defend the exchange rate commitment, and in part to contain inflationary pressures that had already begun to recede. The housing market was weakening, corporate investment was declining, unemployment was rising. Within the ERM framework, the primary adjustment mechanism was domestic policy, not the exchange rate. That adjustment was proving costly. At the same time, Germany was absorbing the economic consequences of reunification. Fiscal expansion in the East and wage pressures across the unified economy pushed German inflation higher. The Bundesbank responded with tight monetary policy, maintaining high interest rates to protect price stability. For ERM participants, this stance had direct implications. To maintain parity with the Deutschmark, other central banks were compelled to keep their own rates elevated, regardless of domestic conditions. By 1992, the divergence was evident. The United Kingdom was in recession, Germany was not, yet the ERM treated both economies as if they could sustain the same monetary posture. The system relied on the assumption that political commitment would substitute for economic convergence, at least temporarily. That assumption was increasingly questioned in private, even as it was defended publicly. Financial markets began to test the arrangement. This testing did not initially take the form of outright speculation against sterling. It appeared instead as a steady reduction in long positions, a cautious reassessment of risk. Traders were not reacting to a single data point, but to a pattern: weak growth, high rates, and limited political flexibility. The pound's central rate began to look less like an anchor and more like an over-evaluation. Among those observing this pattern was George Soros. Through his quantum fund, Soros had spent years analyzing macroeconomic dislocations created by rigid policy frameworks. His approach did not rely on forecasting precise outcomes. It focused on identifying systems where official commitments were misaligned with underlying economic realities. The ERM, as it applied to the United Kingdom, fit that description. Soros did not act alone, nor was he the first to question the pound's position. By the summer of 1992, several hedge funds and proprietary trading desks had reached similar conclusions. The mechanism itself provided the structure of the trade. If the United Kingdom maintained parity, high interest rates would persist, deepening recession and political strain. If it abandoned parity, the pound would fall. The cost of being wrong was bounded. The potential gain was asymmetric. As pressure increased, British authorities reiterated their commitment. Statements from the Treasury and the Bank of England emphasized resolve. Intervention was framed as temporary but sufficient. Interest rates were presented as a tool that could be adjusted if necessary. The credibility of these statements rested on the belief that political will could override market skepticism. In early September, events accelerated. Italy devalued the lira within the ERM, signaling that adjustment was possible, even for large economies. This move did not relieve pressure on sterling. It intensified it. Markets interpreted the devaluation not as containment, but as precedent. The question was no longer whether currencies could move, but which would move next. On September 16, known later as Black Wednesday, the Bank of England entered the market in force. Sterling was purchased repeatedly in an effort to maintain its trading band. Interest rates were raised from 10% to 12% and later announced to rise to 15%. The announcements were intended to signal unlimited commitment. Instead, they highlighted the cost of defense. Market participants responded by increasing their positions. The higher the rates, the more attractive it became to sell the pound if devaluation seemed inevitable. Intervention volumes grew. Reserves were depleted. The exchange rate did not stabilize. By the evening, the government announced the suspension of sterling from the ERM. The rate increases were withdrawn. The pound was allowed to float. In the immediate aftermath, attention focused on individual actors. Soros was identified as the most prominent beneficiary of the move, with estimates of his fund's profits reaching into the billions. He was described alternately as a speculator and a destabilizer. The narrative was simple. A powerful trader had broken a national currency. It was a compelling story and an incomplete one. The decision to withdraw from the ERM was not forced by a single market participant. It was the result of cumulative pressure interacting with institutional constraints. The Bank of England did not lack technical competence. It lacked flexibility. The Treasury did not lack information. It lacked options that were politically acceptable within the framework it had chosen. Once sterling floated, its value fell sharply. Inflation did not surge as feared. Instead, lower interest rates supported recovery. Exports became more competitive. Growth resumed. Over time, the episode came to be viewed by some as a necessary correction rather than a catastrophe. Yet this retrospective assessment obscured the uncertainty that prevailed at the time. The outcome was not foreordained. It emerged from a sequence of constrained choices. For the ERM itself, the consequences were broader. The episode exposed the difficulty of maintaining fixed exchange rates without full fiscal and political integration. It demonstrated that credibility could not be asserted indefinitely in the absence of economic alignment. Subsequent reforms widened trading bands and adjusted rules, but the underlying tension remained. Stability required more than commitment. It required coherence. George Soros later described his position as a recognition of reflexivity, the idea that market perceptions can influence fundamentals, which then reinforce those perceptions. In this case, however, the fundamentals were already strained. The market did not create the misalignment. It revealed it. The speed of the revelation was disruptive. The direction was not arbitrary. Public discourse often reduced the episode to a moral frame. Speculation was portrayed as predatory. Policy defense was framed as principled. These distinctions were rhetorically useful and analytically limited. Markets responded to incentives structured by policy. Policymakers responded to constraints imposed by institutions. Responsibility was distributed, not concentrated. In later years, British officials acknowledged that the entry rate had been too high and the timing unfortunate. These admissions did not negate the original intent, which had been to import credibility and discipline. The failure lay not in the objective, but in the assumption that credibility could be borrowed without cost. For financial historians, the event occupies an ambiguous place. It is cited as an example of market discipline and as a cautionary tale about fixed exchange regimes. It is also remembered as a moment when the limits of national autonomy within international systems became visible. None of these interpretations is sufficient on its own. What remains notable is how quickly the system adapted once the constraint was removed. The pound floated, policy adjusted, markets recalibrated. The disruption was sharp but not prolonged. The ERM continued, altered but intact, eventually giving way to a different form of integration. The episode did not resolve the tension between political commitment and economic divergence. It clarified it. The visibility of that tension, briefly and expensively achieved, did not eliminate it. It receded, as such things often do, into institutional memory. The system adjusted, as it often does. What remained unresolved was not the question of blame, but the conditions under which commitment becomes indistinguishable from constraint.